Welcome back to the deep dive, where we take complex financial language, all that market noise, and these overwhelming stacks of sources, and we just distill them down into crystal clear insight just for you. Today, we are tackling a term that it sounds pretty clinical, but it often brings with it this huge wave of panic and uncertainty. We're talking about the market correction. And if you're following the financial headlines at all, you know this word is thrown around constantly. It creates so much confusion. Is the market just having a bad day? Or is something, fundamentally adjusting? That confusion, that noise, that's exactly our target today. Our mission is to take the foundational definitions of a market correction that you shared with us and just pull out the precise metrics, the intricate timing mechanics, and really the surprising clarity you need. We want to move you from being just a confused observer to, well, a truly well-informed analyst, to draw that clear line between market chatter and quantifiable financial reality.
And that mission is just so vital because the term correction, it implies something necessary, right? A healthy readjustment of price. But unless you understand the rules that govern it, it just becomes another word for loss. So we need to zero in on those numerical thresholds and maybe more importantly, the operational definitions. I mean, how these things are actually calculated. That's the only way to really appreciate what a correction is signaling about the health of the market. It's about getting past the headline number and into the actual methodology.
Precisely. And our source material for this, it gives us this beautifully clean foundational explanation. It focuses not just on that 10% drop, but on how that drop is measured. This idea of a retrospective calculation, which is a fantastic detail. And it gives us clear examples from major stock indices all the way to assets completely outside the equity market, like commodities. It really is an intellectual shortcut to understanding volatility. So let's start right there at the anchor point. Okay, let's unpack this numerical anchor. Every market event, it seems, has a threshold, a line that once you cross it, changes the entire category of what's happening. So what is that hard and fast rule that separates just your standard day-to-day volatility from an official capital C correction?
The internationally accepted, the definitive threshold that marks the official designation of a market correction. It's a decline of more than 10% in the value of a major stock index, and that's measured from its most recent high. That 10% is the metric. It defines the magnitude required for the event to be classified as something significant.
Why 10% though? That number feels so rigid. I mean, a 9.8% drop can feel absolutely catastrophic if it happens in like 2 days, but technically it wouldn't qualify. And on the flip side, a slow, grinding 10.1% drop over 6 months would qualify. So how do we justify that rigidity when the experience of it can be so different?
Well, that numerical rigidity is. It's essential. It's about creating a shared language in finance. The 10% figure didn't just appear out of thin air. It really solidified as a convention over time, probably because it's a significant round number. Behavioral finance teaches us that round numbers just carry this psychological weight. When an index loses 1/10 of its value, it forces institutional investors, the media, everyone, to treat it as something more than just, a little profit-taking. Historically, a 10% drop was seen as the minimum needed to signal that the market's momentum had fundamentally broken down. It prompts a deep reconsideration of valuations. Anything less could just be chalked up to noise or sector rotation or just temporary fears. But that 10% threshold, it forces the question, was the market wrong about its recent peak? So yeah, it's the widely accepted benchmark for signaling a significant pause or even a reversal of recent gains. It moves the whole discussion from daily movement to structural adjustment.
I really appreciate that distinction, that idea of separating signal from noise. Okay, so let's move to the mechanics, because this is where a lot of people get tripped up. We're talking about a movement of more than 10%. How is that drop actually calculated? The source highlights a really crucial operational detail here. Stock market corrections are often measured retrospectively from recent highs down to their lowest closing price.
Yes, in that point. The retrospective measurement and the focus on the lowest closing price. It's not just a technicality. It is absolutely fundamental to the integrity of the definition. Think about it. During any given trading day, prices fluctuate wildly. You might see a flash crash where an index dips 15% in 10 minutes, but then it recovers completely by the close. If we use those intraday lows, the market would just be perpetually moving in and out of correction status every single time volatility spiked. It would be meaningless. So the official metric focuses on the closing price, because that is the definitive settled value when all the trading stops. It's the price at which final trades settle, where index values are calculated. It strips away all the emotional noise and the high-frequency trading chaos of the day. What you're left with is the realized verifiable loss.
So just to make this concrete, if the S&P 500 peaks at 5,000 And then during some volatile Tuesday, it plunges to, say, 44.50. That's an 11% dip. That certainly feels like a correction. But if volume picks up in the last hour and the index closes at 45.10, which is only a 9.8% drop from the high, we are officially not in a correction. It has to be that lowest closing price that dips past the 10% mark.
Exactly. The integrity of all financial reporting rests on that settled price. And then the retrospective element means we're looking back from today to the absolute peak that came before the downturn. You have to identify that single highest point. It could have been yesterday, it could have been 6 months ago. And then you track the subsequent decline to the lowest settled point since that peak, which means the correction is often only fully confirmed and quantified after the fact. We are defining the past, not trying to predict the future.
Huh. But doesn't that reliance on the lowest closing price, confirmed retrospectively, effectively mean that financial media and analysts are always late to the party? I mean, they're reporting on the perception of fear during the day, but the official status is only confirmed hours later, once the market has either settled its nerves or failed to.
That's a powerful critique, and it really highlights the tension between speed and certainty. And yes, the official designation lags the emotional experience, but that delay serves a vital function. It prevents market participants from overreacting to what might just be temporary turbulence. The market is waiting for the institutional high-volume trading community to finalize their convictions at the close. If the majority of investors decide to hold or to buy back in before that closing bell, the official metric confirms that the underlying confidence hasn't broken yet, even if panic peaked midday. It ensures the data is solid, not fleeting.
All right, so we've established an entry point, that 10% plus drop from a high, confirmed by the lowest closing price. Now we have to define the exit. And the source is equally precise on this, and it kind of defies the intuitive assumption that once things start recovering, the correction is over. The correction's official end state is only achieved when the market attains new highs.
This is probably the most crucial nuance for you, the learner, to grasp. You might think that once the index recovers 90% of its loss, the event is over, but that's not so. The cycle is only concluded when the index officially surpasses its previous high. It has to establish a new peak. The source's direct instruction here: stop saying the Dow is moving in and out of correction. That's a really powerful editorial statement. It means a market can't be in a correction on Tuesday, out of it on Wednesday, and then back in on Thursday. Once that 10% line is crossed, the index is in a correction cycle. And that cycle is only concluded when the market demonstrates the collective confidence break the old ceiling. So if the market dips 15%, recovers 14%, and then just hovers below the old high for months, technically it is still in that correction cycle until it achieves that final new peak.
Wow. That distinction is paramount for accurate financial reporting and analysis. It really turns the correction from just a temporary event into a specific required journey. The market isn't just recovering losses, it's validating its future growth trajectory.
Exactly. And when you connect this to the bigger picture of investor psychology, the market always operates on future expectations. That original peak price, it reflected a set of optimistic expectations. When the correction hits, those expectations are recalibrated downward. It's only when the market musters enough collective conviction and that forward-looking momentum to break that old high, only then does it officially signal that the correction was completed. It signals that the long-term, fundamental upward trajectory has been fully validated and resumed. It really is the ultimate sign of restored confidence.
Okay, so we've anchored the correction at that 10% threshold. But as we all know, sometimes markets just keep sliding. If a correction represents a significant pause, a readjustment, what happens when that readjustment fails and the pessimism just gets deeper? Where is the line drawn between a garden variety correction and the far more ominous territory of a bear market?
The definitive line is drawn at 20%. A bear market is typically defined as a sustained drop of more than 20% from recent highs. So those two rules, the 10% and the 20%, they establish a very clean quantitative hierarchy. Crossing that 20% line signals a fundamental change in the market environment. It's a shift from just an adjustment to systemic doubt.
Right. That 20% threshold is so critical because it suggests a change in kind, not just in degree. A correction is often seen as, a temporary detour or maybe a necessary cleansing of some froth. A bear market, though, that implies a fundamental shift in momentum. It usually signals some underlying economic weakness or a crisis of confidence that could lead to a recession. And I want to focus on that word you use, sustained, in the definition of a bear market. It's not just about hitting 20% one afternoon.
Yes, the word sustained is the crucial conceptual differentiator. While corrections are often sharp and rapid like quick shock absorbers that resolve in weeks or months, a bear market typically implies a longer, more grinding period of pessimism. When the market dips past 20%, it suggests that the issues driving the decline are deep-seated, they're systemic, and they're probably related to deteriorating economic fundamentals. Things like unemployment, corporate earnings collapsing, or credit freezes. And because those factors take time to manifest, and even longer to resolve, the bear market isn't just a quick drop. It's a new, entrenched regime of doubt that can last, on average, over a year, sometimes much longer. That prolonged nature is what we mean by sustained. The market isn't just taking a breather, it has entered a whole new environment.
The source material describes this beautifully. It compares corrections to bear markets and notes that historically corrections have been shorter, sharper, and steeper. Let's dedicate some real time to dissecting those three powerful adjectives. What do they tell us about the velocity and the duration of these money movements?
That triad of adjectives, it really summarizes the typical market experience perfectly. Let's start with shorter. Corrections generally resolve quickly because, well, the market is pretty efficient. If the decline is based on some temporary fear or policy uncertainty, capital often moves back in rapidly once that uncertainty clears up. The index either finds its footing and starts that upward recovery toward a new high like we just defined, or it fails to hold, and it accelerates its slide into that 20% plus territory. But because they're often driven by these external shocks, the market just tends to process and absorb the shock quickly.
So we're talking about market digestion time. If the market digests the negative news and starts recovering quickly, it was a correction. But if it fails to digest it and just continues to regurgitate pessimistic data, then we transition to a bear market.
Okay.
Now, what about sharper?
Sharper refers to the velocity of the initial decline, the rate at which money floods out of the market. That correction phase, the 10 to 19.9% loss, is often characterized by rapid, immediate selling. You can almost picture it as a vertical drop on a chart. The sharpness is often driven by immediate, headline-grabbing news or program trading, or just a sudden realization that valuations were extremely stretched.
It's the panic selling that compresses the initial loss into a very brief timeline. But this raises an interesting question. Can't a bear market also be sharp? I mean, we saw some incredibly steep drops in 2008 and 2020.
Oh, absolutely. The onset of a bear market can be very sharp, but the sustained period that comes afterward is often a long, slow grind. What differentiates the two is really the recovery pattern. In a correction, that sharp drop is often followed by a V-shaped, or maybe a U-shaped, but still quick recovery. In a bear market, the sharp drop is followed by prolonged stagnation and further smaller declines, a sequence of lower highs and lower lows. The difference is the market's inability to muster the conviction it needs for a meaningful bounce back.
And that brings us to the third one, steeper. Does that relate directly to the gradient of the decline relative to its duration?
Yes. The gradient, or the slope of the loss, is steeper in a correction because the time scale is compressed. You might lose 15% in just 2 months. Graphically, that looks very steep. In contrast, while a bear market loses far more, let's say 35%, that loss might be spread out over 18 months. The total loss is greater, but the day-to-day gradient on the graph is actually shallower. The pain is amortized over a much longer period. So the key takeaway here is that corrections are punchier. They deliver a massive blow quickly, while bear markets are these prolonged struggles that erode your capital slowly over time.
Okay, let's pull this back to the learner. Why should you, our listener, care so deeply about this technical distinction between 10% and 20%?
Understanding this distinction it's the cornerstone of managing your expectations and mitigating emotional panic. It really is. If you hear the news report a correction, you know you are likely in a temporary phase that, historically, resolves relatively swiftly. The market is adjusting prices to current reality. You can frame the event as a temporary pullback. But if that market crosses the 20% line, you have to shift your mental framework. You have to acknowledge a deeper, more systemic problem, which demands adjusting your expectations for a potentially much longer period of difficulty, maybe even years. This knowledge moves you past emotional panic, which often leads to selling at the absolute bottom, and into rational analysis based on precise quantifiable rules that can inform your strategy. It's the difference between bracing for a tough quarter and bracing for a tough economic year.
Definitions are powerful, but nothing grounds the data like applying it to a concrete, real-world example. And our source material provides a perfect recent case study involving the S&P 500 index. This allows us to apply all the definitions we just talked about, the 10% rule, the retrospective measurement, the new high requirement, to a precise historical timeline. So let's transition right into the mechanics of this S&P 500 correction that's cited in our source.
The specifics of this event are really ideal for illustrating these definition boundaries. The S&P 500 index fell a total of 18.9% from its peak to its trough.
That 18.9% figure is just so instructive. It perfectly illustrates the line we just spent all that time drawing. It was clearly more than 10%, so it officially qualified as a correction. But it stopped just short of that 20% threshold needed to trigger the bear market designation, that 1.1% difference in loss. That meant the difference between headlines screaming bear market begins and those reporting market correction continues.
It was a textbook near miss, no question. The market was clearly sending strong negative signals. The selling pressure was enormous and it was fast. But crucially, just enough underlying support, or maybe long-term institutional conviction, was retained to prevent it from crossing that ultimate 20% threshold. What's really interesting about that 18.9% drop is what it implies about the causes of the volatility. A drop that fast and that severe, but that stops short of 20%. It often suggests the pain was driven by fears about future conditions, things like aggressive central bank action or inflation spikes or geopolitical instability. Not so much current tangible economic collapse. If the drop had hit 25%, we'd likely be looking back at a period of massive corporate earnings failure or sustained unemployment. But since it stopped at 18.9, the market retained faith that the economic fundamentals, while maybe slowing, were not entirely broken.
Let's trace the mechanics of that fall, using the specific dates the source provides. When did the selling pressure begin, and when did the index hit its absolute lowest closing price?
The decline began at the high point, which was February 19, 2025, and the index hit its lowest closing price, the trough, on April 8, 2025.
Okay, let's reflect on that timeline for a second. From February 19th to April 8th, that's about 49 days. It's easy to look at those 2 dates and see a clean statistical 49-day slide, but for you, the investor or the learner living through it, those 49 days were likely filled with panic headlines, daily uncertainty, and rapid-fire decision-making. That sheer speed of loss, nearly 19% erased in less than 7 weeks, that is the operational definition of a correction being shorter and sharper.
That speed confirms the nature of the event. It wasn't a slow, grinding realization of economic weakness. It was a rapid reaction to a significant acute shock. That short, steep timeline is the hallmark of a correction driven by immediate fears, where selling pressure reaches maximum intensity very quickly before it stabilizes. It forces investors to ask, am I selling into a temporary shock, or is this the beginning of a long decline? The fact that the index stabilized on April 8th suggests that, collectively, the market decided the shock was temporary.
Okay, so the market found its floor, its lowest closing price, on April 8, 2025.
Okay.
That's according to our definition from the first section. The correction isn't over yet, not even close. The recovery phase begins now. And we have to analyze this recovery against that strict requirement that the correction only ends when it hits a new high.
Right. That period between April 8th and the eventual new high, that's the battleground. The market has to claw back that entire 18.9% loss and then push beyond the original February 19th peak. And this recovery phase is often volatile because every time you try to approach that old high point, you meet selling pressure from investors who are just relieved to break even and get out. What's fascinating here is that the speed of the recovery validates the severity of the initial classification. Had the index just stalled out for a year after that drop, the consensus would likely shift to viewing that initial 18.9% as something far more structurally problematic than a mere correction.
And the source material is definitive on the final conclusion of this whole cycle. When did the S&P 500 officially signal that this correction was over?
The correction officially ended when the index set a new all-time high on June 27, 2025.
So let's put that full correction cycle into perspective for you. The initial painful decline, that lasted 49 days. But the entire correction cycle, from the high point on February 19th to the definitive end when that new high was set on June 27th, that lasted a total of just over 4 months, roughly 128 days.
And that total duration, 128 days, it provides a concrete, real-world measure for that shorter characteristic of a correction, especially compared to the multi-year slog of a bear market. The market adjusted, it absorbed the shock, and then it quickly resumed its long-term growth trajectory. Hitting that new peak on June 27th wasn't just about recovering dollars, it was a psychological validation. It confirmed that the market had indeed only suffered a temporary detour. It confirmed that the initial peak was fundamentally reflective of the right long-term trend.
This case study also brings up the question of measurement nuance again. I mean, what if the S&P 500 index had been the only one correcting, and the Dow Jones or the Nasdaq had remained stable or even kept climbing? Does a correction need to be across all the major indices to really count?
That's a key analytical challenge, and it's often glossed over. The definition of a correction applies to the specific index being measured. So, yes, you can technically have the S&P 500 in correction territory, while the Nasdaq, maybe driven by a specific insulated sector, continues to hit new highs. However, analysts generally look for a broad market correction that involves several major indices to classify the event as systemic. But the S&P 500, since it's the broadest measure of U.S. large-cap equities, it often acts as the de facto proxy for the overall health of the equity market. Its 18.9% drop was severe enough to just dominate the narrative, even if other indices have performed slightly better.
So in summary, the 2025 S&P event was just a perfect illustration. It had rapid velocity, sharper and steeper, a short duration of 128 days for the whole cycle, and it was a near miss on that 20% bear market line. And it culminated in the required new high for official closure. It's a precise definition applied to a very volatile reality. We've spent a lot of time defining and analyzing corrections using equity indices, and that's because it's where the term is used most frequently. It's where the data is measured in minutes and hours. But financial markets are vast. The definition of volatility and price adjustment has to extend beyond the high-speed trading of the stock exchange. So what does this all mean for other markets?
This is where the concept really shows its true utility. The term correction is not exclusive to stocks. Our source material expands the application, noting that a correction may also be a significant drop in a commodity price. And this forces us to think about assets that move on much slower, more tangible timescales.
And what's fascinating here is the specific, tangible example cited in the source. The 2000s United States housing market correction. I mean, we are moving from numbers blinking on a trading screen to the price of physical property. How does the concept of a correction even apply to something as massive, slow-moving, and regional as an asset class like housing?
Well, when we apply the term correction to a commodity or a major asset like housing, the fundamental purpose stays the same. The price is adjusting downwards because it had previously exceeded what the market deems its fundamental sustainable value. In the housing market context of the 2000s, the decline wasn't based on some instantaneous loss of investor confidence in a stock ticker. No, it was based on the slow, inevitable realization that prices had become utterly detached from the core economic fundamentals of the people living in those houses. Prices were no longer justified by income levels or rent-to-own metrics or sustainable lending standards. The correction in this case was the painful, protracted process of prices shedding that excess valuation that was driven by speculation and lax credit.
I want to focus on that connection because it goes right back to the introductory line of our source material, new equilibrium price of a commodity. Applying that phrase to housing makes the definition incredibly tangible. When the housing market corrected, it was the search for this new equilibrium price.
That concept, new equilibrium price, is the most profound takeaway from applying this term so broadly. In an economic sense, equilibrium is just the price where supply and demand balance sustainably. If demand gets artificially inflated, for example by speculators flipping houses or banks giving mortgages to people who couldn't afford them, the price moves way above that true equilibrium. The correction, therefore, is the violent and necessary process of returning to a price where supply and demand are balanced based on real economic variables. Things like median income, local job growth, sustainable debt-to-income ratios. For housing, the correction didn't stop until prices had fallen enough to align once again with genuine affordability metrics. The 10% plus drop just provided the threshold for acknowledging that this readjustment was of crisis magnitude. It differentiated it from normal cyclical ups and downs.
So even though the timescale is dramatically different, the S&P 500 correction we just analyzed lasted 128 days, while the housing correction lasted for years. The metric of a 10% plus decline from the peak serves the exact same function. It signals that the market believes the price had inflated beyond what is fundamentally sustainable.
Precisely. The percentage provides the magnitude of the necessary adjustment, while the concept provides the rationale. The mechanisms of how you measure it change, but the core meaning of the correction does not.
And let's look at that difference in measurement mechanics. With the S&P 500, we're relying on the lowest closing price, confirmed daily. In housing, we're relying on median sale price data, which is compiled monthly or even quarterly. The lowest price in housing is only found through a much slower retrospective look at transaction data. the median sale price dropping month after month until a bottom is definitively established in the rearview mirror.
The principle of retrospective measurement holds true, but the speed of the data capture changes completely. With stocks, volatility means we confirm a correction within days. With housing, the massive lag in transaction data means that analysts might take 6 to 12 months to definitively say that the housing market has corrected by 10%. And what's more, the end of the correction in housing is rarely defined by attaining a new all-time high quickly, like with stocks. The end is often just defined by stabilization around that new equilibrium price, which might be sustained for years before any true appreciation resumes.
This contrast really highlights the flexibility of the definition. It's a concept that's sturdy enough to apply to both the fast-moving world of financial derivatives and the incredibly slow, tangible world of physical assets. And all while retaining that core meaning, a significant, necessary readjustment of valuation. This has been a deeply clarifying exploration into what it actually means to talk about market corrections. Before we leave you with a final thought, let's just quickly solidify the 3 non-negotiable quantitative concepts that you, the learner, should now carry forward.
First, the definitive threshold for classifying a correction is a drop of more than 10% in the value of the asset or index from its recent peak.
Second, the measurement of that drop is retrospective. It focuses on the lowest closing price in equities, or the equivalent verifiable trough in other asset classes. And this ensures the metric is based on realized loss, not just temporary volatility.
And third, and maybe the most surprising part, is that the correction cycle is only officially closed when the asset or index attains a new all-time high. That validates the long-term upward trend. And this distinction between the 10% correction and the 20% bear market gives you the power to categorize market events based on magnitude and expected duration.
You are now equipped to distinguish market noise from market realities based on precise, quantifiable rules. So when you hear the word correction now, you know exactly what magnitude of loss it represents and the specific path the market has to follow to officially signal the end of that adjustment cycle. We always like to leave you with a final provocative thought to mull over, one that builds on these concepts of adjustment and equilibrium. Since a correction, whether it's in stocks or commodities, is essentially a market readjustment, and our source material explicitly mentions the establishment of a new equilibrium price, we have to ask,
does the term correction fundamentally imply the market was wrong? That the preceding price was inflated, irrational, or driven by unsustainable sentiment before the drop occurred?
And if the market was fundamentally wrong at the peak, what does the fact that the S&P 500, in our case study, attained a new all-time high in a mere 4 months imply? Was that initial 18.9% drop just a momentary panic, a collective lapse in confidence that was quickly corrected before validating that the original upward trend was, in fact, correct all along? Keep digging, keep learning, and we'll catch you on the next deep dive.